In 1930, the United States Congress passed the Smoot-Hawley Tariff Act. It raised tariffs on over 20,000 imported goods to record levels. The intention was to protect American workers and businesses from foreign competition. Within 2 years, U.S. imports fell by 66%. U.S. exports fell by 61%. Global trade collapsed. And the Great Depression, which had begun as a severe but potentially recoverable recession, deepened into the worst economic catastrophe in modern history. The economists who warned against the bill at the time gathered over 1,000 signatures on a petition urging President Hoover not to sign it. He signed it anyway. Today, the United States has imposed tariffs on its largest trading partner that at their peak reached 164%. Trading partners have retaliated, global supply chains are being restructured, and a summit this week in Beijing is attempting to negotiate a way back from the edge. The situations are not identical, but the mechanism is the same, and the mechanism has a documented outcome. To understand what happened in 1930, you need to understand the context. The stock market had crashed in October 1929. The economy was contracting. Unemployment was rising. American farmers were struggling with falling crop prices. American political pressure to do something was enormous. Smoot-Hawley was the something. The bill started as a targeted measure to protect American agriculture. By the time it passed through Congress, every major industry had lobbied for its own protection. The result was a sweeping tariff increase across 20,000 product categories. The logic seemed straightforward. Higher tariffs on imports mean American consumers buy American products. American companies sell more. American workers keep their jobs. The logic ignored one thing. Trade is not a one-way street. When the U.S. raised tariffs, trading partners raised theirs in response. Canada, America's largest trading partner, immediately retaliated with matching tariffs. Britain abandoned its historic free trade policy and built a preferential trading bloc within the British Empire. Europe retaliated across the board. American exports, the goods U.S. farmers and manufacturers were trying to sell abroad, became too expensive for foreign buyers. The markets that American producers depended on closed. The cure accelerated the disease. The U.S.-China trade conflict is not Smoot-Hawley. There are critical differences that matter. In 1930, the U.S. was a creditor nation with a trade surplus. Today, it runs a massive trade deficit. In 1930, the dollar was on the gold standard. Today, it is the global reserve currency. In 1930, there were no global supply chains. Today, they connect every economy to every other economy in real time. These differences mean the transmission mechanism is different, but the core dynamic, tariffs triggering retaliation, triggering a contraction in trade volumes, is identical. What the historical record shows clearly is this. Tariffs designed to protect domestic industries do protect some domestic industries. Steel producers benefit when steel imports are taxed. Semiconductor manufacturers benefit when foreign chips face barriers. But every protected domestic industry has downstream customers who pay higher input costs. Those customers make products that become more expensive. Those more expensive products sell less, and the jobs created in the protected industry are partially offset by the jobs lost in the downstream industries paying higher costs. The net effect of tariffs is almost always smaller than the protection effect and larger than the retaliation effect. Smoot-Hawley didn't cause the Great Depression, but it turned a severe recession into something much worse by eliminating the international trade that could have shortened the recovery. The current tariff regime has not caused a depression, but it has restructured global supply chains in ways that will take a decade to fully absorb, and the costs of that restructuring are distributed unevenly across the economy in ways that are still becoming visible. History shows us very clearly who benefited from the Smoot-Hawley era and who didn't. Winners in 1930. Domestic producers in protected industries saw short-term relief. Companies that had accumulated cash before the crash and could acquire distressed competitors at low prices built lasting advantages. Countries that maintained open trading relationships with multiple partners weathered the contraction better than those dependent on bilateral relationships with the U.S. Losers in 1930. Export-dependent American industries, agriculture, manufactured goods, lost foreign market access permanently in some cases. Countries economically dependent on U.S. trade suffered severe contractions. The global multilateral trading system that had been building since the 19th century was set back by decades. Winners now. Countries that position themselves as alternative manufacturing bases, Vietnam, Mexico, India, are receiving investment that would have gone to China. Domestic semiconductor manufacturers in the U.S. and allied nations are receiving subsidies and preferential treatment. Companies that moved supply chains early are ahead of those still adjusting. Losers now. American consumers paying higher prices for electronics, clothing, and consumer goods. Small businesses that cannot absorb input cost increases the way large corporations can. Developing nations caught between the two competing economic systems with no clean alignment available. The Smoot-Hawley era ended, eventually, with the Reciprocal Trade Agreements Act of 1934. The U.S. stopped trying to raise tariffs unilaterally and started negotiating bilateral trade agreements that lowered them reciprocally. The multilateral trading system that eventually emerged, the GATT, then the WTO, was built on the lessons of Smoot-Hawley. The lesson the policymakers of 1930 took from 1930 was simple. Unilateral tariff escalation produces retaliation. Negotiated tariff reduction produces expansion. The gains from trade are real. The costs of losing access to trade are also real. And the political popularity of protection doesn't change its economic consequences. The current situation will also resolve, eventually. The question is how. The historical pattern from every major trade conflict suggests three possible trajectories. Negotiated de-escalation. Both sides reduce tariffs through a framework agreement. Trade volumes recover, supply chains partially reintegrate. This is the Smoot-Hawley to GATT trajectory. It took about 4 years. Managed bifurcation. The U.S. and China maintain high tariffs with each other, but both trade freely with third parties. A two-track global economy emerges. This is the Cold War trade pattern. It lasted 40 years. Escalation to economic decoupling. Tariffs become prohibitive in both directions. Trade between the two economies approaches zero. Each builds entirely separate supply chains. This has no clean historical precedent at this scale. The closest analog is the complete breakdown of European trade in the 1930s. The Beijing summit this week is an attempt to stay on the first trajectory. Whether it succeeds determines which of the other two becomes the default. The economists who signed that petition in 1930 were right about the mechanism, even if their predictions about scale turned out to be conservative. Trade restrictions trigger retaliation. Retaliation contracts trade. Contracted trade deepens recessions. Deepened recessions produce political pressure for more protection. More protection triggers more retaliation. The cycle is self-reinforcing until something breaks it. In 1930, it took a depression, a world war, and 20 years to build a new international trading system. The tools available today to break the cycle are more sophisticated. The stakes of not breaking it are higher. What history tells us consistently across every trade conflict in the modern era is that the question is never whether free trade or protection is more politically popular. The question is whether the economy can afford the full cost of the choice being made. In the next video, we look at another moment when two superpowers fought a trade war and what it tells us about who eventually wins.